but I generally have a positive view on liquidity for the next 12 months, and therefore my view on Bitcoin is also positive for the next 12 months. They have a lot of correlation together, and the handful of times where we see Bitcoin break its correlation with liquidity, it's often due to valuation extremes. That I expect liquidity to go up over the next year, and I don't see any signs of like extreme Bitcoin valuation. That combination generally leads me to be pretty bullish on Bitcoin.
Lyn Alden expresses a moderately positive outlook on liquidity for 2025, indicating signs that we may be emerging from a period of peak credit tightening in the United States. This shift towards a more favorable liquidity environment is crucial as it sets the stage for potential asset price movements. Additionally, she notes that globally, increased stimulus measures from China further contribute to this pro-liquidity stance. Alden's perspective on Bitcoin also turns optimistic. She points out that liquidity and Bitcoin have a historical correlation, where Bitcoin's price movements often align with liquidity conditions. In instances where Bitcoin has deviated from this trend, it's typically due to valuation extremes rather than fundamental shifts.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
So I'm moderately positive on liquidity for 2025. I think that, as I mentioned before, we're kind of coming out of signs of peak credit tightening in the U.S. And so that's pro liquidity. And globally, we're seeing more stimulus out of China. That's generally pro liquidity. And like we talked about earlier in the interview, what happens to the TGA in the first half of 2025 is a big yes or no variable for what happens with liquidity. You could have $800 billion of TGA money pushed back into the banking system, or not, depending on if the debt ceiling becomes a protracted battle or not. So I don't really have a big opinion on magnitude, but I generally have a positive view on liquidity for the next 12 months, and therefore my view on Bitcoin is also positive for the next 12 months. They have a lot of correlation together, and the handful of times where we see Bitcoin break its correlation with liquidity, it's often due to valuation extremes. And there's a bunch of different ways to measure Bitcoin valuation. You can look at like on-chain analytics and stuff like that. Generally my favorite is market cap to realized cap, which is to say, market cap is like what's the current price of the coin multiplied by how many coins there are. Realized cap is like the on-chain cost basis. It's like the current value of all coins the last time they moved, the dollar price last time they moved. And so when you get those really big bull runs, sometimes market cap can get way ahead of realized cap. Whereas other times market cap is not that much higher, or in rare cases below realized cap. And those tend to be less dangerous from like a valuation standpoint. The sentiment and the overbought status is less extreme. So when we look at that, I expect liquidity to go up over the next year, and I don't see any signs of like extreme Bitcoin valuation. That combination generally leads me to be pretty bullish on Bitcoin. Well, I think a lot of that is liquidity. It's similar to the 2000s decade. So you saw gold go up quite a bit that decade, while the S&P 500 also recovered from its post.com lows. So it's not like S&P 500 and gold can't go up together. If you look at emerging markets, often because of the denominator is debasing so quickly, stocks and gold are going up together relative to that currency. So I think a lot of this is indicative of liquidity. So late 2022 was the liquidity bottom. And as you see in the chart, that was also the bottom of a lot of these other assets. And so, ever since that period, we've been recovering in liquidity. In the recent liquidity research report I collaborated with Sam Callahan on, we measured how correlated different asset classes are to liquidity. Bitcoin was number one, and then gold and the S&P 500 were also pretty high. When you get down into like international stocks and bonds, it's less so. In addition, what we've generally seen in this past, like call it 2 years of this rally, is we've seen a rally in quality. So S&P 500, soared back to new highs. Bitcoin's chopping right around its highs. Gold's new highs. Whereas look, for example, at like ARK. So ARK Innovation ETF, unprofitable tech stocks, that's still nowhere near its highs. When you look at broad crypto, the vast majority of them are nowhere near their highs. And so so in 2021, you had a rally in like everything. You had a rally in quality, you had a rally in junk, everything's going up. And what makes this rally somewhat different, one is that the liquidity is less explosive than 2021, even though it's positive. And two, because of the high interest rates and kind of mixed economy, this has been a situation where quality really does matter. It's not just everything going up. It's things that are profitable or that are the best in class of what they do. So gold rallied better than other precious metals. Bitcoin rallied better than most other cryptos, at least anything of scale. And NASDAQ rallied better than ARK. Because it's profitable companies versus often unprofitable companies. It's not to criticize ARK. It's just to highlight what a segment of unprofitable tech stocks generally is doing compared to the really wide moat entrenched profitable entities out there. So it's been a quality rally.
Alden anticipates at least 50 basis points of interest rate cuts, though she cautions against overemphasizing the impact of these cuts. Historical data reveals that even when the Fed cuts rates, long-term yields may rise, which complicates the borrowing landscape. The current financial environment features a partially inverted yield curve, indicating that short-term rate cuts may not translate into lower borrowing costs for consumers and businesses. Alden points out that many corporations and individuals have locked in low long-term debts, suggesting that substantial refinancing cycles may be unlikely. This phenomenon marks a significant shift from previous cycles, where interest rate cuts typically spurred widespread refinancing and borrowing. In the current context, a significant portion of the market is insulated from the impacts of rate cuts, raising questions about their effectiveness in stimulating economic activity.
I try to not look too much into seasonality or presidential election cycles, even though they are relevant. I don't just think that that's the only variable that matters. During the first half of the Trump administration, the market was kind of rapidly pricing in tax cuts. So that, they did tax cuts without, for the most part, corresponding spending cuts. And so they basically did a stimulus when we already had an economic expansion. So it's kind of like rocket fuel. And then for the Biden administration, the first year was still fairly early in the recovery from the lockdown-induced recessions, combined with stimulus that started under the later years of Trump with the stimulus checks and then continued under Biden. And so those were both pretty notable. You would generally expect that if we get a Trump victory, probably the market starts pricing in another round of tax cuts of some sort. And if we get a Harris victory, it's a little bit more complex because she has a mix of wanting to increase some taxes while keep others low. So we have to remember that some of the Trump era tax cuts automatically expire by the end of next year. So I think that the Fed policy is only partially looking at inflation. I think they're looking at other variables as well. Back when they were fighting inflation harder in the early 2023, when we had a regional bank crisis, they favored kind of saving the banking system over getting inflation down as quickly as they could. And now they're cutting interest rates while inflation is still above their target. It's down, but it's above their target. In addition, the Fed only has a handful of levers to deal with inflation. So what the Fed does with their interest rates is that they try to encourage more borrowing, like more credit creation, or they try to slow down credit creation, depending on if they're trying to stimulate or they're trying to fight inflation. And the problem is that in the current environment, bank lending is only a small percentage of money creation. The fiscal deficits are a bigger component of it. So back in the 70s, bank lending was a bigger aggregate amount than fiscal deficits, whereas now, they got bank lending to a very low level. Overall private credit growth, they successfully got it to a pretty low level, but that when they're running 7% of GDP deficits, there's still this like high watermark that's hard for the Fed to deal with. So, and they're not really interest rate sensitive. If interest rates go up, their deficits get even bigger. and they don't really cut spending based on the deficits. And if they were to have dysfunction in the Treasury market, that you'd see the Fed step in and assist with it. So I think that that's one of the complicating things, is that when the factors of inflation are outside of their control, they're not exclusively looking at inflation anymore, and instead they're looking at a holistic thing of inflation, banking system stability, Treasury market stability, and so some of those things can lead them to be more dovish than you'd otherwise expect from the inflation data that they see. Yeah, my base case is looking for at least 50 basis points of cuts, and we'll see what the data says to warrant more of that. I try not to look too far ahead, because the market, they'll price in 7 cuts at one point, and then like a quarter later they're pricing in 3, and so instead what I'm generally focusing on is, okay, we're expecting mild cuts. The problem is that doesn't necessarily translate into borrowing costs going down. We saw, for example, with this 50 basis point cut, long end yields went up. And that is historically pretty unusual in modern history, for them to cut rates by that much, and then like the 10-year Treasury and mortgages go up. And that's close to what actually businesses and people are borrowing at. They're not borrowing at Fed funds. They're generally borrowing in the middle, the longer end of the curve, and their interest rates didn't really come down. We still have a partially inverted yield curve, which means that again, short end cuts might not really affect borrowing costs. And an argument that I made earlier this year is that even when we get a fairly substantial cutting cycle, like let's say when we go down a total of like 150 basis points from the top, we're probably still not going to get a very big like refinancing cycle, because so many people already locked in low long rate debts at even lower levels. So this will be the first cycle where we probably don't get a lower low in interest rates, either short end or long end. And that means that while it does help, say, small businesses, and it does help some of the unlucky people that took out mortgages at like the peak, it doesn't really result in this really big refinancing cycle. Same thing for investment grade corporations. A lot of them have locked in pretty long duration debt at low rates. And so interest rate cuts are not very impactful for them. Even some of the biggest names in the S&P 500, like Alphabet, for example, they have more cash than debt. And so actually lower interest rates, if anything, are mildly hurt them, because if they've locked in a little bit of long-term fixed rate debt, they're holding a cash balance that earns interest. And if we cut interest rates, they get less interest income. And so we got this kind of like top heavy system that I think is not going to be very responsive to interest rate changes. So people will be focusing on, is it going to be, by X date, is it going to be 50 basis points of cuts? Is it going to be 75 basis points of cuts? Is it going to be 100? And while that matters, I would generally argue that it matters less than people expect, because this is not a credit-driven cycle. It's a fiscal-driven cycle, and so the fiscal side is more impactful.
Lyn Alden's insights highlight a cautiously optimistic view on liquidity heading into 2025, with potential positive implications for Bitcoin and other quality assets. The interplay between liquidity, fiscal policies, and market dynamics creates a complex landscape for investors. As we navigate this environment, understanding these factors will be crucial for making informed decisions.
Please like and subscribe my channel.